Afternoon, and thank you for joining this KFI webinar, Stablecoins and Banking, Digital Asset Risks and Opportunities for Financial Institutions. While all attendees have joined in listen-only mode, we encourage you to engage with our presenter through the Q&A feature on your control panel. To learn more about KBRA Financial Intelligence, simply scan the QR code on screen. Should you have any additional questions on the topics discussed today, we are always available for a follow-up call. Now, I'd like to hand things over to KFI's Head of Research, Sean McGovern, who will lead today's presentation.
Good afternoon, everyone. As you heard, I am Sean McGovern, Associate Director here at KBRA Financial Intelligence. I'll oftentimes call that KFI for short. So if you hear that, KBRA Financial Intelligence. Really excited to bring you this presentation today. Very hot topic, as I'm sure you know. Very near and dear to my heart, actually. I have been doing research on digital assets, stablecoins, as specifically Bitcoin, stablecoins, things like that, going all the way back to 2017. So very excited to be here in front of an audience of a lot of different banks today, a lot of institutions. Very exciting. What I do here at KFI, as you heard, is I am the head of research. I publish our insights reports. And we've covered stablecoins in the banking system a lot in our insights over the past several months. Our insights are available to clients and non-clients alike. They're totally free. If you find anything like this interesting, anything we talk about, data, content, whatever, you should sign up for our insights so you get those sent straight to your inbox. You can do that at our website, kbraanalytics.com. And once again, that is, you go to the KFI tab there and you get to our insights. So that's a little bit about me, but I also want to introduce KFI. I know that we have some familiar faces here today, but I know we have some new people as well. And just to kind of give you an overview of what we do here at KFI, we launched in 2020 as a data provider for nearly 10,000 US banks and credit unions, combining our proprietary KFI scores with comprehensive banking data for peer benchmarking analysis and to help manage counterparty risk. And those are our two major use cases: peer benchmarking, counterparty risk, and that makes our products pretty useful for banks and large depositors alike. You can see we have a really wide spectrum here of different kinds of clients, banks and credit unions, but also associations, insurance, corporates, all across that spectrum. I mentioned those KFI scores, and what that is a proprietary model that incorporates institutions' asset quality, capital adequacy, earnings performance, and liquidity and funding metrics to create a score that runs A, B, C, D, E, that corresponds to strong, sound, adequate, and weak financial conditions. So you get down to that D and E level. That would be weak financial condition. Our analysis shows that 96% of banks that failed from 2010 through 2025 had a KFI score of D or lower prior to their FDIC date of failure. And we have those scores for all 10,000 banks and credit unions. So if you are at a bank or a credit union, you'd like to find out what your score is, you can reach out to us and we can talk about getting that to you. In addition to our KFI scores, we have a large, robust data platform with many different data sets in it. At the very top of this, we'll have the call reports for banks and credit unions. And actually what you'll see today in our presentation, which I think is pretty unique, is that we work a lot of call report data into this. And that's because there's not really a whole lot of call report data out there. I mean, there's really no call report data out there that specifies anything about digital assets. But what we found is that you can get certain data points from certain banks that can kind of tell you a little bit about digital asset adoption in the banking system and what that might look like. And I'll show you actually some of our data sets today through that. In addition to the call reports, we also have UBPR, bank holding company reports, gap filings for the publicly traded firms, our KFI scores, as I mentioned, summary of deposits data, which hydrates a nationwide map of bank branches and the deposits at those branches, M&A data we rolled out this year, enforcement actions, CRA ratings, macroeconomic and demographic data, and all of these data sets go into those insights reports that I talked about. That insights research is taking on all these different kinds of macro-focused ideas in the economy, technology, politics, regulation. We cover it all. We use our data sets to put right into those insights research reports, and that actually helps us inform our users about our use cases. So without any further ado, no more introduction. Let's actually get right into the meat of our presentation today. I've been to a lot of these panel discussions, speeches, all these different things about digital assets this year in banking. And I find that oftentimes there's a lot of context missing. And I think that's because you go back to 2024 and digital assets in banking, there was a very proscriptive regulatory environment, right? There wasn't a lot of movement happening just because there wasn't a lot of clarity and not a lot of just not a lot of clarity. We'll just leave it at that, right? But in 2025, we had this huge change in the regulatory environment, and that has brought on a lot of pressure, a lot of questions for banks. All of the sudden, are you doing this? How are you doing this? Kind of a lot of pressure, right? So I think it's important that we address the context of how we actually got here before we jump into all different kinds of use cases and how bank income might be affected, things like that. And I just want to start by defining terms, right? If we define what a stablecoin is for our purposes of how we're going to talk about it today, it's going to generally be defined as a digital token with a stable value derived from a one-to-one peg to the underlying value of a currency or a similar fungible asset. So we'll going to be talking about USD denominated stablecoins today, but you can also have stablecoins that are denominated in euros or pesos. There's even stablecoins that are pegged to other assets like gold, right? The USD denominated stablecoin supply has grown from just $300,000 in 2015, about a decade ago, to almost $300 billion today. Now, when we talk about that peg, we use that term a little bit loosely, or at least I use a little bit loosely. That peg really is just an issuer's guarantee that you can show up with one stablecoin token issued by them, and you can redeem that for $1. It will always be redeemable for $1. That's what really maintains that peg. Oftentimes, you'll see on cryptocurrency exchanges that the prices do fluctuate, that sometimes you'll see a stablecoin at 99 cents or even $1.01. That's because the way the prices work on exchanges can kind of be influenced by arbitrage and trading and things like that. But ultimately, that peg comes from the fact that the issuer has a pool of reserves that are supposed to be backing the stablecoin one-to-one, right? Now, the market share for these stablecoins is very highly concentrated among, I mean, really, you could say highly concentrated among one issuer, but two kind of stick out as the two largest that make up about 85% of the market capitalization. That's going to be Tether and USD Coin. Tether is an offshore entity, as are many stablecoin issuers actually. USD Coin, the issuer is Circle Financial, which you've probably actually heard about. They had a pretty large, successful IPO earlier this year, and that's based in the United States. Tether, you can see their market cap is around $180 billion, USD Coin around $75 billion. You put those together, you have 85% of the stablecoin market. And that concentration partially comes from the fact that you have first mover advantage. Stablecoin products are somewhat hard to differentiate. And so some of the earliest guys to the game, they're dominating the market, right? And really up until this point, there has not been a whole lot of ability for large, well-regulated US-based institutions, traditional financial institutions to really integrate into this system. But that is starting to change, right? And if you actually go back to the origins of where stablecoins came from, stablecoins filled in the gaps that banks were simply not ready to meet when it came to servicing a 24/7, 365 digital asset market that was created by Bitcoin. Bitcoin is a global asset. It's not domiciled anywhere. It can trade anytime, any place, peer-to-peer or across exchanges, right? And so there was very significant demand for a digital form of liquidity that could be moved across exchanges for arbitrage purposes or trading over the weekend or any time, any place, right? And this is going back quite a while. I mean, we're talking about 10 years ago. There's no Fed now, so there's not even really like a system for small to mid-sized payments to be going around when banks are closed, right? So that's where the stablecoin comes from. And there was a lot of scrutiny about stablecoins early on, particularly their reserves, right? At first, there was no reserve reporting. There was kind of just take our word for it, right? Then you had Tether start to publish what were called attestations. And these attestations were essentially just a piece of paper that said, we have this many assets and this many liabilities, with the liabilities being the tokens. And they had an independent auditor come in, an independent auditor that pretty much no one had ever heard of before, and sign off and say, yep, at this point in time, these were the assets and these were the liabilities. Now, that did get better over time. There was a breakdown of the asset composition of those reserves. And although there was more transparency in that, that also revealed that most of the reserves were actually composed of commercial paper from undisclosed issuers. Now, you could say that that commercial paper was rated A and it was, good commercial paper, but that's not really a guarantee, right? And so scrutiny was still very high. And once again, most of this was being done offshore. However, now we've seen that the reserve assets have gone through an evolution where most of the reserves are U.S. Treasury bills, as well as repurchase and reverse repo agreements, right? And if we just look at how much that's worth now, the attested reserves of Tether and USD coin within those reserves, about $133 billion of those are just U.S. Treasury bills. And then actually there's going to be tens of billions of dollars more if you include the repo and reverse repo agreements as well. And this is very significant, one, because obviously it makes the reserves healthier, makes the reserves more liquid and just much more higher quality, but also it fundamentally changes the incentive that the United States government has to actually, instead of try to keep these things out of the financial system, to say, okay, wait a minute, maybe we can leverage our financial system to create a safe harbor here, to create a regulatory environment here in the United States. Well, why is that? Well, if you have hundreds of billions of dollars of new demand coming in for treasuries, that can lower the United States Treasury's borrowing costs, right? It can, over time, if you're talking about potentially trillions of dollars coming in for new Treasury demand, that can lower the borrowing costs significantly. And that kind of gives the United States a new incentive to say, maybe this is something that we should be fostering. And if you look at the scale of banks' holdings of treasuries, the two largest stablecoin issuers, they're already on par with almost 2,400 U.S. bank holdings of the treasuries. Now, the 25 largest banks, obviously, they're going to that hold U.S. treasuries. They're holding a lot more than the rest of the 2,400 at the bottom there. But if you can bring that scale into the market and you can have these large institutions that are well regulated, trusted, all that, you can expand this market significantly. And once again, that has fiscal benefits for the United States. And so I talked at the beginning about this sort of regulatory revamp, right? How things have changed so much in 2025 all of a sudden. And we should probably walk through that a little bit, talk about exactly what changed, like which things were passed, which things were rescinded. And we can just start right at the very top with SAB 122 being released. That rescinded SAB 121. So that's Staff Accounting Bulletin 121. That was released by the SEC, I believe in 2023, that was not a prohibition on publicly traded firms holding digital assets on behalf of their customers. But if you were to hold digital assets on behalf of your customer, if you were a bank to do that, those assets had to be put on the balance sheet as a liability and therefore had to be balanced on the asset side by some kind of assets, right? And that's completely untenable financially to do custody that way. Traditional custody, it's all held off the balance sheet. It's not on the balance sheet. And so they were carving out this special kind of treatment for digital assets that was prohibitive in the nicest terms, right? But with SAB 122, rescinding SAB 121, that enables banks to offer digital asset services without inflating their balance sheet liabilities. In that same vein, later in the year, you had the OCC releasing Interpretive Letter 1183, which affirmed that banks can partake in digital asset activities as long as they're following regulations and laws, and rescinded Interpretive Letter 1179 and the agency's supervisory non-objection pre-approval requirement. And that just means that if you were a bank and you wanted to have any kind of involvement with digital assets, offer any kind of services, you had to get pre-approval. You had to send in a written letter to the OCC, and the FDIC also had a similar requirement as well. There would be an investigation that would happen of your bank. There would be all these different checks and safeguards, and it was just not a process that I don't think anybody really wanted to go through. I'm not aware of anyone that went through that process, and any banks that went through that process and came out on the other side with an approval. So it was not. It was once again not a prohibition, but kind of just the regulators' way of saying, if you try this, we're going to make it difficult for you. The Federal Reserve Board also rescinded some of their supervisory letters and interagency statements that discouraged bank crypto exposures, going along in line with similar things that we saw at the OCC. And then, probably the most important thing that's happened this year is the Genius Act. Federal stablecoin legislation passed for the first time in the United States, creating a regime for payment stablecoins, key term there, payment stablecoins, and replacing a patchwork of state money transmitter rules. The way that actually worked in the past, I know Circle went through this with USD Coin, was they had to go to all these different states and get money transmitter licenses. What the Genius Act does is create a federal regulatory environment now that you can issue payment stablecoins, right? If you're a bank, you have to create a subsidiary to do that, right? But ultimately, this creates for the first time a serious regulatory framework. And the thing about the Genius Act that's really surprising is that it passed at all. We're potentially coming out of the longest government shutdown in history today, but one of the few things that is kind of bipartisan seems to be new frameworks for digital assets and cryptocurrencies, right? That's pretty surprising that something like that was able to get passed. I mean, granted, there's a lot of money now in crypto, a lot of lobbying money kind of floating around DC. But ultimately, I've always looked at it as, if you live in a democracy and you have more and more people owning these assets, right? You're not going to win votes by opposing this, because more and more people are embedding these in their portfolios. They want to make money off digital assets. They're going to vote in their financial interests generally. So I've always seen it as kind of a matter of time before digital assets really had acceptance, and the government kind of started being more friendly and putting regulatory frameworks in instead of trying to push this stuff out. So that's the Genius Act, and we'll come back to that. We'll talk about that in more specific terms. But remember, payment stablecoin is going to be a stablecoin that's used for payments. It's not a security. It's not going to be something that yields some kind of interest payments, or it's not supposed to. There's a little bit of controversy about that, but ultimately, that is the Genius Act. Later on in the year, you also had the CFTC, so the Commodity Futures Trading Commission, launched an initiative to facilitate tokenized collateral, including stablecoins, in derivatives markets. Now, that kind of starts to look like a step toward, if you can collateralize stablecoins in derivatives contracts, maybe we're starting to get closer to where you can collateralize stablecoins and lend against them. These can be collateral for loans, right? And the most recent development, which is also absolutely huge development, is Federal Reserve Governor Christopher Waller floating the concept of skinny master accounts. Now, just to kind of give some context about who Chris Waller is at this moment, he's one of only 7 Fed governors, right? And he's potentially in line to be the next chair of the Federal Reserve Board of Governors. He's one of the only Republicans on the board. Jerome Powell's term as the chair runs out in May of next year, and there's a search currently on to find the new chair, and it is possible that Waller could be that guy. He could be the next chair of the Federal Reserve, and he's been talking a lot about stablecoins recently, and in pretty friendly terms, and talking about payments in general, like he's talking about with the skinny master account, right? Providing non-banks limited access to the Fed's payment infrastructure. And what that means is that if you're a stablecoin issuer, and just say you can get one of these skinny master accounts, that there will be restrictions on it compared to the full master account. There'll be caps on balances. You won't be able to get interest from it. You won't be able to borrow from the discount window. But ultimately, if you hold your reserves at the Federal Reserve through this skinny master account, you're talking about central bank money now is effectively backing stable coins, or it's making the stablecoin reserves safer. And the Federal Reserve has more options about how to stabilize the financial system if something were to go wrong with a stablecoin issuer. And by going wrong, there was some kind of misleading reporting of their reserves, something like that. The Federal Reserve has more options. Instead of it being all outside of the Federal Reserve, it might be good that the Federal Reserve does have some oversight. They do have some options here with something like a skinny master account, which actually could benefit banks too. I mean, if you're a smaller bank that has to use correspondent banks to get access to a master account or something like that, a skinny master account might be available to you as well, to give you access to that Fed payment infrastructure, right? But ultimately, this is the first time we might see that payments firms can actually get access to the Federal Reserve payment systems. So before we move on here, I do want to ask our first poll question of the day. Now that we've kind of set the stage with all this context, all regulation, structure, things like that, how would you describe your bank or non-bank institution's current stance on digital assets and stablecoins? I know we have a lot of banks here today, but we also have a number of non-banks as well, actively exploring use cases, monitoring developments, but not engaging, skeptical, risk-averse, or no internal discussion yet. If you have another answer, you want to expand on your answer a little bit, you can use our Q&A feature, actually. You can send in questions to us to, you want to make a statement even, you want to, however you want to do it. If you have more to say on this, please feel free to use the Q&A feature. I see we have one question actually already. Can I get these slides? Absolutely. We will send these slides, the whole presentation, all this will be sent to you, as well as a replay of this presentation will be sent to you after we finish up here. I think that's enough time for our first poll question, if we can get the results up. Monitoring developments but not engaging seems to be actually almost 2/3 of our responses there, is the number one. Actively exploring use cases at 16%, skeptical, risk averse at 9%, no internal discussion yet at 13%. So mixed bag there, but you can see monitoring developments but not engaging is the clear favorite. And that actually leads well into our next slide here, because I want to talk about features. Adoption, right? So we talked about the regulation, we talked about the structure, we get it, right? But why would there be adoption of this? Why would there be continued adoption is really more of an apt thing to say, because adoption's actually been very strong for stablecoins around the world. But the primary point I really want to drive home, and as I said at the top, there's a lot of pressure, there's a lot of questions being asked of banks already on this, but you will not, as a bank, get to decide when the adoption happens, right? Your customers will decide that. The merchants will decide that you do business with, right? Your business partners will decide when this stuff gets adopted, and you don't want to be behind the curve. That's kind of the ultimate thing that matters is, even if there's not a huge amount of adoption today, that could change very quickly. I mean, we've seen over the past 3 years, if we just look at the actual transaction volumes we can see here on chain from stablecoins and compare that to ACH and Visa over the same period, it's very significant. You look going back to October 2022 to October 2025, the growth of ACH payment volume has gone up 15%. Visa's up 11%. For stablecoins, it's 525% over the past 3 years. So that just shows you how significant the uptake is. And a lot of this is not for retail payments. People are not buying a lot of goods and services with this. This is lots of financial kinds of transactions, right? But that can change very quickly. And there's a few different incentives to actually make that happen. First of all, you have very small fees associated with stable coins. Right now, if you're talking about interchange fees for the traditional 4-party card model or something like that, you're looking at 2 to 3% of the transaction. For that is essentially coming out of the merchant's pocket. By using stable coins, you can effectively eliminate that fee, or at least bring it down to just a few cents, right? They can also be incentivized by stablecoin issuers with rebates, things like that. Hey, use our stablecoins. We'll give you a rebate on these transactions for this. That's actually pretty popular. And in the same way, customers can be incentivized to use stablecoins by cashback on stablecoin transactions. I know that Shopify is already doing this. If you use USD coin on Shopify, and that specific merchant has enabled USD coin payments, you can get 1% back, almost kind of supplanting the need for a credit card right there. Ultimately, it's not like consumers have to know all about stablecoins to want to use them. They just have to know what the incentives are. And I keep using this term incentives, right? So you have that for the merchants. They can keep more of their transaction. Customers also can keep more of their transaction effectively through cashback. You also have the potential for real-time settlement because these transactions happen instantaneously. And that improves liquidity management for businesses. That reduces the float. the amount of time that cash is trapped sort of in traffic. The payment's made, but it's not settled yet. With real-time settlement, that changes the game in liquidity management. And I know there's been a lot of time spent on talking about how stablecoins are great for international payments and all, and that is very important. I think that's less important to smaller banks, which is a large part of our audience here today, are smaller banks. They're not really doing a whole lot of international payments like remittances and things like that. But if you are working with a business, if your clients are businesses and they're an importer, this is a big deal. If they're receiving payments in stablecoins because it's instant, right? It can be sent overseas very quickly. They might want stablecoin accounts because that's payment that's coming in if they're dealing with an importer, right? So there is an element of that international payments thing, even when you're dealing with if most of your business is domestic, right? As a bank. Also, right now, the way that stablecoins are set up is that there's a lot of branding. You have USD coin, you have Tether, you have this coin, that coin, whatever. And then you have all these different networks. You have Ethereum and you have Solana and you have, Tron, you have all these different networks. What's happening with that is that there's a declining difficulty and cost associated with cross-chain and intra-chain swapping of stables. So if you have a stable coin that's on Tron, you have a stable coin that's on Ethereum, they can kind of switch chains really easily and for almost no cost because of these layer twos that have been rolled out. You have the base layer of the blockchain, and then you have a layer two, which makes things a lot easier and quicker and can add a lot more features. That improves the user experience. That enables what I call agnostic stablecoin usage, where if you're the user, you just see dollars and cents on your screen. You don't see necessarily which stablecoin you're using, what chain you're using. That's all managed on the back end by some kind of vendor, right? I think that's kind of where we're getting to, where stablecoins are just effectively dollars and cents on the screen, and which stablecoin, which network, things like that. The user might not need to manage that as these become more popular and there's more adoption and there's more incentives to use them. So those are some of the features that may drive adoption. I want to jump in now, and we kind of talked about this a little bit. You might be wondering, well, why are the fees so low, right? Why do they happen instantaneously? How is that possible? And more so, if banks are losing out on, say, that 2 to 3% with an interchange fee or something like that related to retail transactions, what does that look like? How does that impact bank income? Well, there's actually 3 different sources of non-interest income that I highlighted in a recent insights report, and I sought out to quantify this. I've heard a lot about how stablecoins can start to erode interchange fees. They can start to erode wire fees and overdraft. And I'm like, okay, but what number is that? I actually went right into KFI here, and I just pulled out the actual quarterly data for interchange, overdraft, and wire fees. And you can see that there's tens of billions of dollars quarterly wrapped up in these 3 different fee types, these ancillary fees, right? And that's anywhere from 15.5% to 18% of all non-interest income in the entire banking system in the United States. So that's very significant if that starts to erode over time. So the reason that these transactions are very cheap and they're very quick is that when you're dealing with a stablecoin, it's a shared ledger. The reason that bank transactions can be risk-bearing and complex, and you have all this messaging and reconciliation because you have all these different ledgers that need to be updated right before settlement can truly occur. With a blockchain, everyone's on the same ledger. It's all shared, and so there's no messaging back and forth. There's just simply no process between multiple parties with separate ledgers. That just doesn't exist, right? And when you talk about how that can start to take away from interchange fees, it becomes very obvious, right? Wire fees. There's no wire fees. There's no interchange fees. There's just a network fee. And when you're talking about stable coins, it's very low because it's just a token going back and forth. Overdraft fees are specifically interesting, right? An on-chain address can't be overdrafted. It cannot transact beyond its balance. That removes the credit exposure that underlies overdraft fees. And because an address on the blockchain is effectively free, there's no cost associated with it, that wipes out a lot of other account management fees as well that might otherwise exist, right? So there just doesn't the overdraft simply does not exist on chain. So if we're talking about kind of starting to quantify how significant is this disruption, we're talking tens of billions of dollars here just in the non-interest income alone. So moving on from here, I also want to talk about how stablecoins can cut into the deposit base and actually how that flows downstream to lending, right? I've seen a number so many times at this point. As much as $6.6 trillion in deposits could face partial disintermediation pressure. And that's actually from the US Treasury. This table here to the right, that I'm taking directly from a US Treasury Department report. And that 6.6 trillion number, when you add a little bit of context, that kind of changes things. If you look where that's actually coming out of, it's coming out of M1 money. And that's going to be other checkable deposits and demand deposits. And it's flowing into that stablecoins figure there on the box. And if you read that, though, stablecoins as envisioned under the Genius Act. So that's not really accounting for the fact that if these stablecoins can find a way to generate yield and they're not just payment stablecoins as envisioned under the Genius Act, there could be even more deposits that could be at risk. And this is where we come into what's called the Genius interest loophole, that the Genius Act has this supposed loophole. And some people debate whether it's a loophole or not, but ultimately what it does is that, yes, the stablecoins themselves generally cannot bear it cannot be a money market fund under the Genius Act, right? It can't act in that way. However, if you go on Coinbase, which I've been a Coinbase customer since 2017, I use Coinbase. And if I put a bunch of money in USD coin and I hold that USD coin on Coinbase, I get rewards, air quotes, rewards. And they even quote it in an APY, right? It's effectively interest, right? Now, it's not interest and it's actually not paid by the issuer. It's paid by Coinbase. It's an incentive fee to hold these funds on Coinbase in USDC. And it's not interest, but what does it sound like, right? So if you start to kind of put that into the mix, I feel like we're talking about a little bit more than $6.6 trillion that could face partial disintermediation pressure. Doesn't necessarily mean it flows out of the banking system totally, but it may not be expressed in deposits anymore. It's going into stablecoins, and it's really just a matter of where are those stablecoins? Who's hosting these wallets, right? There's also a whole other thing out there called decentralized finance, which I think you should get pretty familiar with, actually. I think that's one of these terms that if you walk away from this with nothing else, decentralized finance. Those are applications that sort of exist on the blockchain where stablecoins are really the backbone for lending and yield generation. These are automated money market funds, liquidity pools for decentralized exchanges, lending and money market funds that are going on in this decentralized finance economy, which has anywhere from $130 billion to $170 billion already locked in it with pretty high yields. I mean, you can get a yield up to 10% potentially on something like Tether. These stable coins are like the gold standard of liquidity in these decentralized finance markets. And I think at some point there has to be a way for banks to sort of start to plug into DeFi so that they can compete, so that they can give their customers access, even if it's like a walled garden kind of approach where it gives them access to some different kinds of decentralized finance protocols, something like that. That's something that I think banks should probably get familiar with if they want to remain competitive, if they want to find ways to allow their customers to not only just hold stablecoins, but also to take part in that stablecoin ecosystem, which goes far beyond just the payment aspect of the product, right? Since stablecoin tokens are fully reserved, some depositors may view the use of well-regulated stablecoins as a form of proxy insurance above the FDIC limit. And so what I mean by that, this is actually a conversation I had with someone from a state banking association. This is something they're taking very seriously, where a bank deposit versus a stablecoin token, stablecoin funds are fully reserved, assuming that the issuer is being honest with their accounting treatment and they're not lying about what's in their reserves. Each token should be reserved by an asset, but their deposits in a bank account are only insured up to $250,000. So that could also create this disintermediation that large depositors might say, well, I could have more than 250,000 in that account, and I could have multiple accounts, but I'll also have some in stablecoins because I know that those stablecoins, once again, assuming that the issuers are well regulated, I know that that stablecoin deposit will have an asset behind it, right? These are some of the concerns that could potentially cut into that deposit base. And when you cut into the deposit base, you create pressure for deposits to go out. The way that you try to bring those deposits back in or hold on to them, you might have to raise whatever you're paying on those deposits. The cost of your deposits might have to rise, right? And that can start to cut down on the net interest margin, obviously. So when you cut into the deposit base like that, when you raise sort of the market rate on what's going for capital, that can have a very serious impact on the profitability of lending over the long term. So this is, once again, some of the risk that we're talking about here with not interest income and then interest income as well in the deposit base. So moving on from there, I do want to talk about what options banks have. So we talked about the risk, and I promise we talk about the benefits as well. And we finally got to that part. We could talk about the benefits. Well, yeah, obviously, large banks may have the ability to launch and manage their own stables. I know that Bank of America CEO said explicitly, we're going to get into that business. They're probably going to launch a stable coin. SoFi, actually today, they're the first national bank to launch Bitcoin trading for their clients. That just came out today. But they're also going to launch a stable coin, right? And so those are some larger banks that can do that. Smaller banks might also seek to do this. I know that there are some stablecoin pilot programs right now. There's Bank of North Dakota, I believe, is doing the Rough Rider coin, and they're a community-sized bank, right? And they're going to work with Fiserv to do that. Another example of that is PayPal USD, which is their stable coin, which launched all the way back in 2023, but you can see has just exploded over the past couple of years, going back last year from about $500 million in token supply all the way up to over $2.5 billion in token supply there, right? And so how that works is that PayPal is responsible for all the marketing and all of the stuff to bring it to their clients, right? But on the back end, there's a company called Paxos that manages the reserves, and they manage all the technology and everything like that. So white labeling stablecoins is an option for banks of many different sizes, I think. There's also a consortium model that is popular already among fintech firms. I know USD Coin has a consortium with Coinbase and a bunch of other people in there. There's been a consortium, or there's been reports about a consortium that might be forming among very large banks, similar to how they all got together on Zelle. Maybe now they might get together on a bank stable coin. And also, I was just at a conference in October. I was at the Independent Bankers Association of Texas conference. And that was the first time I've seen any banking association talk about launching their own stable coin. And that is something that the Independent Bank Association of Texas does plan to do. There's not a whole lot of details on it yet, but they are going to be creating some kind of stablecoin network, something along those lines that I'll be looking forward to hearing more from them. And I think that they will be the first of actually several different associations to do something like this. You also have deposit tokens. Some people have looked at deposit tokens as something that happens after stable coins, but I feel like deposit tokens are something that could be onboarded before stable coins. I think deposit tokens could actually enable sort of a hybrid model, sort of a stepping stone into stable coins and other digital asset products. When we talk about deposit tokens, that's going to be very different from a stable coin. I mean, it's very simple in that a stable coin is backed by this pool of reserves, where deposit tokens are backed by deposits. It's just a tokenized representation of the deposit that already exists, and you're just putting that on chain, right? And that doesn't even have to be used externally. It could be used intrabank. It could be used interbank, however you want to use it, but you don't have to necessarily use those for payments and things like that. That's not really how it has to be used. One great example that I actually want to highlight that I've seen in my years actually of using digital asset payments. I have this card right here, and if you look up to where I am in my camera right now, this is a Coinbase card. This is a Coinbase debit card issued by Visa. I've had this since 2019 or 2020. And the way that it works is that I can go to any merchant anywhere that accepts Visa, and I can pay with cryptocurrency. I can pay with Bitcoin, right? Just say I want to go anywhere. I want to pay for coffee and donuts with my Bitcoin. Well, the merchant might not take Bitcoin, but they'll take cash, right? We know that. So Coinbase gives cash to Visa, and then Visa pays the merchant with cash. But Coinbase debits a certain amount of Bitcoin. Say it's $5 that I paid for the coffee and donuts. Coinbase will debit $5 worth of Bitcoin from my account, right? And then they'll put that cash out. They'll front the cash to the merchant. And so in a way, that's sort of almost like a similar way that I think deposit tokens can be used internally, whereas for external settlement and payments, that's all still using the traditional fiat rails that we all know, right? This is a stepping stone, a hybrid model. Actually, what I'm describing to you is called a synthetic settlement layer. This is already something that's pretty well defined. And I think that that's just one way that banks can start to get used to using the blockchain, using tokenized assets, right? Is by using these deposit tokens, and then maybe stable coins come later, stable coin accounts, however you want to do it. Ultimately, I don't think that it has to be stable coins first and then deposit tokens. I think that deposit tokens offer a lot of good options. With that, before we move on, I want to ask our second poll question here. We can pull that up, get you guys involved again, get some thoughts here. If your firm were to explore stablecoin use, what model would be most appealing? Partnership with an established stablecoin issuer, in-house issuance backed by insured deposits, use of a regulated consortium or network model, or something else. Once again, if you have more to say on this, please send it through in the Q&A, and I'll address it when we get to the end of our conversation here. I hope that you're kind of getting an idea of these models and stuff. That's why I waited till after I kind of described some of the options here to ask this question. But I think maybe now you're starting to get better ideas of like, oh, like white label sounds good, or there is hope on the horizon with consortium models, right? I think that's enough time there for our answers. If we can get the results here, I'll read them off. So partnership with established stablecoin issuer. I think I tend to agree with that as a really good option. You can see right on the screen here how successful that has been for PayPal, and I think that could be pretty successful. In-house issuance backed by insured deposits, so kind of going with the deposit token model there. Once again, great option. Use of a regulated consortium or network model. Hopefully that becomes more available. Something else. Well, if you answered something else, I would love to hear about what you're kind of thinking there with how you would want to do this, how you're exploring the use of stablecoins. So we're going to move on to the end of our presentation here, and this is my favorite slide. I've been really excited to show you guys this the whole time here. How banks play offense. That's the number one thing that I hear all the time. How do the banks play offense? I saved it to the end because I want to end on a really high note, and I want to just really kind of show you how one bank is already doing that and how you might be able to bring this same kind of system on board at your bank, right? Obviously, you could have the creation of bank subsidiaries to act as stablecoin issuers or offer custodial services. So being an issuer or being a custodian. And there's a great example out there right now that shows from all the way through the ecosystem how banks can participate. Anchorage Digital Bank, if you are familiar with them, I mean, if you know anything about digital assets, you probably know about Anchorage. They've been a industry leader in digital asset adoption. Well, they were chosen as the issuer of Tether's Genius Compliant USAT. And so Tether, as I said, is an offshore issuer. They're going to launch a Genius compliant token within the United States. They have a US subsidiary, and they're going to now have Anchorage Digital Bank as the issuer. And in turn, US Bank will serve as a custodian for the reserves backing Anchorage's payment stablecoins. I mean, Anchorage might have been able to do that themselves. They do a lot of custody and fiduciary activities, but that kind of eliminates any kind of concerns about self-dealing. It just adds a layer of, that it's not all just happening within Anchorage. They're sort of spreading things out here. And I think a lot of custodian banks will be able to use stablecoin reserves as a way to make a good amount of money here. If you look to the right of the screen, what I have there is the annual income from fiduciary activities at Anchorage Digital Bank. And because Anchorage Digital Bank is really, I mean, it's very much a crypto-focused institution, you can assume that a lot of this income, if not all of it, and this makes up most of their non-interest income, you can see that it's doubled, or it doubled from 2022 onto 2024. And we're only talking about going from 20 million to about $50 million in income here. But this is probably going to set another record this year. You can see through the first 3 quarters of 2025, Anchorage looks like they're on track to set another record year. And they do a lot of different kinds of custody services. It's not just holding reserves for stable coins. But I want to stay on topic here just with the stable coins. And that, I'm not saying that, you know, the biggest custodian banks are going to double their income too by adding digital assets or anything. But you can see how that kind of impact, how big of an impact you can have there, even on a pretty small bank. I mean, we're talking about Anchorage Digital is, I think, about $85 million in assets. Once again, this data comes directly from KFI's platform. We pull this straight from the call reports. But the biggest way that I think banks can play offense, in addition to custody is a great option. I think banks have to get ready for digital asset-backed lending. I talked very early in the presentation about the CFTC already exploring ways that stablecoins and other kinds of digital assets can be used, or tokenized assets can be used as collateral for derivatives contracts. I think the way that banks make income, like significant income from digital assets, is that they do what they're best at. They're lenders. Banks are trusted, highly regulated lenders. They're the experts in lending. That charter, that banking charter, is a very powerful tool. That's why all the fintech companies are now trying to come in and get charters, because of just how much that lends to them. I mean, obviously they can offer other services too, but really it has a lot of power. There's a lot of power in that charter, and that shouldn't go to waste. I think you have to get comfortable with digital asset-backed lending. And right now there's a potential de novo out there, Erebor Bank. I'm not sure if you've heard about Erebor, but it's a digital-focused bank. Their charter got conditional approval from the OCC very recently, and not full approval yet. And in that charter, one of the things they've requested clarification on, and something the OCC will actually have to give clarification on in one way or another, is whether virtual currency used as collateral for the bank's credit products would qualify as readily marketable collateral. And that is, I mean, that's never been asked before, not that I'm aware. And currently, you would assume it's not, right? But we don't know. We don't know kind of what the OCC's feeling is going to be on that. But for approval of this charter, either the OCC is going to have Erebor make a change to take that out, or they will have to give some kind of clarification on whether virtual currencies can be readily marketable collateral, which obviously impacts how much you can lend to an individual, how much you can lend to a borrower, right? That's usually readily marketable collateral is going to be the most highly liquid stuff, the best stuff out there. So virtual currency used as collateral for that. For lending, I think that is where banks really play offense, and stable coins to me are the first step toward getting to that point where you're ready to collateralize loans with digital assets. So with that, I'm going to go into our Q&A in a second, but if you'll indulge me for just 2 minutes, I do want to introduce a little bit of our product here, our data wizard here at KFI. That chart that you were just looking at with all that fiduciary income, you can pull that right out of our data wizard here that plugs right into Excel here. I'm just creating a small peer group here of banks that filed a call report in the 3rd quarter of this year, had $2 million in non-interest income. And now I want to see how much, where did the fiduciary income from fiduciary activities? I want to see that, right? I want to see how that breaks down. I can add all those metrics right into this data wizard here. We'll say the last 16 quarters, so that's going to be the last 4 years. Preview that report. We have all those banks with all those previous quarters of data. We can export that right into Excel, and you can use that for peer benchmarking, counterparty risk, whatever your process is. All of it goes right into Excel. Super useful. I use it constantly putting together our research here. This whole presentation was really powered by this data wizard, by our Excel add-in, and all of the other tools we have here at KFI. With that, last thing here before we do our Q&A, just, thank you for giving me your time today. I hope this was insightful. Like I said, this topic really means a lot to me. I find it very interesting. I'm excited to have this audience here today to talk to you guys. And I want to talk to you some more. I hope you'll reach out to us. I hope you'll contact us for whatever it is. You want to talk about this, you want to talk about bank data, anything out there, please get in touch with us. And yeah, I mean, you have all of our contact information right here. These slides will be provided to you after our presentation's done here. And with that, we have about 10 minutes here. And I'm going to close the presentation and I'm going to start taking some questions. If I can get to our Q&A box, which I see we do have a couple. For stablecoin volume, how much is for crypto purchases versus real world assets? I mean, really right now, it's mostly going to be crypto. Well, you could say crypto purchases, or you could say financial transactions going through decentralized finance. And what I mean by that, I'll just dive a little bit deeper into that now that we've gotten through our presentation here. There's in DeFi, you have these smart contracts that are constantly executing transactions autonomously, right? Based on if you're lending through a smart contract, right? There's going to be a time where that transaction happens, but then say like the collateral falls below a certain level. That smart contract, it ends, right? And so the stable coins that might have been collateralized, they might go back to the original lender, whatever it is. There's a lot of different transactions that are happening with stablecoins in DeFi, or like I said, arbitrage between different exchanges. It's mostly going to be financial transactions. I would say I don't have an exact number. I don't think anyone could really give an exact number on what the percentage is of real world purchases versus crypto purchases or something like that. But I would say it is heavily it heavily leans toward crypto purchases, or really toward financial transactions, as I would say. So another question just came in. I love it, guys. Please continue sending in questions here. Stablecoin play for banks is digital asset-backed lending with deposit token pressure, but banks have to spend money on the tech build. So what is the real opportunity for banks? Oh yeah, I mean, that's totally true, right? I mean, that's the thing. You have to invest in this. But I mean, that's the thing, is that if more and more of global capital is moving over into digital assets, whether it's Bitcoin or whether it's Ethereum or whether it's even just stable coins, that is something that simply has to be onboarded, right? Otherwise, you're just playing defense, I think. I mean, if you're just playing defense and, you onboard stable coins, that's great. That's very important to keep your deposits from going out or being disintermediated. But ultimately, that is part of what has to happen, right? There has to be not only investment in capital, there also has to be investment in willing to learn. Because as I said at the very top, I really wanted to get back to the base of what stablecoins are, what digital assets are, explain the basics of how a blockchain works. There's a lot of capital that goes into this. It's not just monetary, but I think that yeah, it is. There will be money spent on tech build, but ultimately over the long term, this move of capital from traditional securities and commodities and moving over to digital commodities, digital securities, that is something that you have to have access to. It's not something that you can just ignore or stay out of. Ultimately, that is where the lending, I think, will move over to. A lot, just more capital will be there in the future. Thoughts on states looking to create their own stablecoin legislation? Do you see that as creating issues or enhancing the capabilities of blockchain technology? Well, already that is kind of how it was. There was no state stablecoin laws, but there were state money transmitter laws, and these were all fragmented and they were all different across the country, right? And now, if you have a state that wants to put their own stablecoin legislation into practice, that's fine. And it's up to the stablecoin issuers. If you're under 10 billion, according to the Genius Act, if you're a stablecoin issuer and you're under $10 billion, you can choose to be regulated by the state. Like if you just want to be at the state level, that's totally fine, right? But you also have that federal option as well. So if states want to be more, if they want to have something that's a little bit different, if they want to, if they want to have something that's unique for their state for whatever reason, that is something that does work into the Genius framework. Now, speaking of the Genius Act, part of the Genius Act, banks can't invest in cryptos. Could this change after this administration? Yeah, absolutely. I think that is absolutely something that will change. And even if you can't have investment in these digital assets directly, there can be holdings of ETFs and other kinds of financial products out there that are not digital assets themselves, but some sort of exchange traded product, or it's just packaged in some other way, right? But ultimately, I do think that there will be some kind of new framework that will allow banks to invest in cryptocurrencies directly. The thing is, I said this as well, that there's so much lobbying funds that are in that are in DC now behind cryptocurrency, and it is bipartisan. It's one of the very few issues out there that is bipartisan. And I don't think that's going to change. I think that will stay bipartisan. Democrats and Republicans kind of want to give people access to these things, and that goes up to the institutional level as well. As tokenized deposits and stablecoins continue to blur the line between traditional payments and blockchain-based rails, what core competencies must banks develop today to remain relevant in a tokenized financial system? And that actually goes back to what I was answering in another question, is that there is a capital intensive investment in terms of money, right? But then there's also, you have to be willing to learn. You have to be willing to understand what a blockchain is. You have to be willing to understand what DeFi is and how to access decentralized finance markets. That's probably a little bit further off, I think, but ultimately, there just needs to be this upscaling and learning, and it's happening very quickly. It's all happening very quickly. I understand there's a lot of pressure and a lot of questions that are coming at banks all of the sudden, but ultimately it just comes down to understanding how you can use a blockchain to build efficiencies within your own operations, and how you can also use it to provide services and products to your customers that will be in demand. So yeah, just core competencies developed today to remain relevant in tokenized financial system is really just get the basics down, spend time on that, bring in talent that knows about this stuff already. I think that there is somewhat higher literacy among younger people. I know that young talent in the banking system is hard to find. That's another thing I'd hear at conferences oftentimes. But opening up roles that are specifically focused on digital assets, that actually makes things attractive for young people. That makes things attractive for people that are into this and have been into it for years. There might be some amount of investment in new staff that you might have to make, right? There's a lot to learn. There's a lot to do, and it just can't be done in the same way that it was previously. If we have any more questions, I'm happy to ask them here. We've got about 3 more minutes left in our presentation. I just wanted to say thanks again for you guys who all came out today. I hope it was informative once again. I really hope we have a couple more questions. I love answering these questions. This is really exciting for me. Especially, talking about stablecoins. Just one little anecdote I'll tell you guys. The first time I gave a presentation on stablecoins was all the way back in 2021, and it was hard back then. It was really hard. And I even said something, along the lines at this presentation. This is 4 or 5 years ago now, where I talked about how that you could have this potential where stablecoins start to dollarize the global financial system even more so than it already is, where you have whole countries that prefer to use stablecoins as opposed to their local currencies. And that's another thing too, is that stablecoins fill this need overseas for financial services as well, outside the United States. One of the most interesting things that I found in Chainalysis. If you're not familiar with Chainalysis does forensic analysis of blockchain financial markets. And they found that in the United States, adoption for blockchain and digital assets was very high. Like Bitcoin was the number one thing. Bitcoin was the favorite by far. But if you go everywhere else outside the US, outside of the developed world, you sort of go into the emerging markets and the frontier markets. What you find is that stable coins are very, very popular because you have this dollar-denominated liquidity that is available and accessible to virtually everyone, right? So that's the difference, is that here in digital assets in the United States, we're very focused on Bitcoin, Ethereum, things like that. And stable coins are in that mix. They are still very high, very strong focus. But elsewhere in the world, in parts of Asia and Africa, Latin America, stablecoins are the premium. They're the number one product that everyone really wants access to, and that's a little bit of validation from something that I saw, or at least I thought I saw as the future back in the past, and now seems to be coming to reality. So with that, I think that those are all of our questions for today. I want to thank you all once again for coming to our presentation today. You will get a recording of this if you'd like to go back and review all this. You will get the slides as well if you want to see some charts that we presented today. Anything at all, please feel free to reach out to me, reach out to anyone from my team if you'd like to learn more about KBRA Financial Intelligence. Everyone have a great afternoon, and hope to see you again soon.